was around 2010, 2011, all this double dip recession fear of, we're going to go back into a recession. And anybody that was in the market that was participating, like I was participating back then, about that. And the market went through some pretty big volatility. I think it was kind of toward the end of 2010-ish, if I remember. And I remember still them talking about that even into 2011. Double dip recession. If I had, my gosh, a dollar for every time I heard that term on CNBC during that time period, it was ridiculous. I had them so sick of talking about double dip recession all the time. And they kept talking about it, and it never happened. And we just kind of kept prospering. And then growth actually picked up nicely kind of toward, 2012 into 2013, 14, and growth kind of picked up from there, right? And so anyways, it is kind of like a thought process that's important. Now, the one thing I'll push back against is obviously at that time we had rates at near 0%. Right now we have rates around 5% Fed funds rate, right? So it is something that's working against the market right now. When fund managers are bullish and, let's say they're saying, I think they're wrong about recession or this or that, right? Some people run to the conclusion of, oh yeah, sure, they're saying that because they just want to keep their clients invested so they can, earn the fees on that and whatnot, right? I can tell you this. You can make actually far more money if you were actually coming from more of a bearish standpoint from your clients, at least in the short term, because the more you kind of preach that, the more your clients kind of need you to navigate that sort of market. If you're just kind of bullish and you say, stocks are going up, then us clients could just move money to an index fund because they're like, oh, we're in the clear, we're fine. When things get shaky, that's when people get uncertain and they're like, wait, how should I navigate this, right? And so I just think that's always an important factor to keep in mind, that a lot of fund managers, sometimes it might be a little more inclined to preach doomsday type stuff because they know then their clients are going to feel like they need them because they're going to have to do more advanced strategies. It's not just buy the Qs and we're good. It's not just put the money in the S&P 500 index and we're good, right? By coming out and saying the S&P is going to fall 20%, 40%, 50%, whatever, clients start thinking, well, I would love to capitalize on that, but I don't really know how to navigate that. And so they're much more inclined to give their fund managers money. And so that's just, I think that's something that, has to be thought about both sides of it, okay? So what you could do if you really felt like you needed a hedge for a stock, let's say you're super heavy long a stock, let's say you got $100,000 in Apple, let's say, for instance, and you're like, man, I'm really worried about these earnings. You're like, I think it's going to go down, but I don't really want to sell the stock. So what you could do is you could buy, let's say, some 160 put options, something that's at a 160 strike price, maybe a 155 strike price, maybe a 157.50 strike price, something like that. So just in case, for whatever reason, the earnings are really bad and the stock tanks, you can obviously save some face in a situation like that. Other than that, you could sell, but it's just like, if you're a long-term investor, it usually doesn't make sense to try to time these things out like that, right? If you want to buy $1,000, let's say you had a $100,000 position in Apple and you want to buy $1,000, $2,000, $3,000 of puts on the stock, you could do that. You don't have to do it just for 1 week out. You could always go a month out. You could go a couple months out, something like that. If you're just really concerned about Apple stock price in the short term or something like that. Now, those decisions or a little more short-term in nature decision. So, you don't want to get too far into that mindset because the next thing you know, you're making short-term decision after short-term decision. You can always hedge your portfolio going into a new year. You can always hedge your portfolio going into a new year just around November, December, or if you're a little late to the game, you could do early January hedge and be good, for the year in terms of that. Amazon stock, AMZN, okay? So, Amazon, I'm really excited about this business for a lot of different reasons, and the valuation is extremely attractive, and I think the risk reward of mega cap stocks is probably about the most attractive in the world at the moment, okay? Last year was really Meta stock. This year it's really Amazon stock, okay? And so when I'm buying Amazon, you got to remember, I'm getting the number one e-commerce company in the world. I'm also getting the number one cloud company in the world. And so I'm actually buying two gigantic, large businesses that are going to obviously grow exponentially over the coming years, right, in terms of the e-commerce business and the cloud business. So both those businesses have a long way of growth ahead of themselves. I'm also getting a gigantic advertising business now that is becoming very, very dominant. It's not as big as Google's advertising business. It's not as big as Meta's advertising business, but it's becoming very large for Amazon now at this point in time. I'm also getting Whole Foods. Amazon owns Whole Foods. I'm getting Twitch. I'm getting, Amazon's actually making their own semiconductor chips on a very high level now at this point in time. So I'm getting that side of their business. I'm obviously getting the Alexa side of their business and many other businesses Amazon has as well. Okay. Now, this matters in a significant way for Amazon and how this company's valued. Okay. Because check this out.
So in the last quarter, Amazon beat their EPS estimates by quite a substantial margin. They beat it by about 10 cents, okay? Now, for a company like Amazon, that matters in a pretty darn significant way. And the reason being is if you have a company coming in and beating by several $billion in terms of their revenue, beating EPS like that, then it makes it more likely that the company's going to likely keep beating throughout the year. And ultimately, analysts will have to start bringing up their expectations for the company, okay? Now, as far as analysts to this next quarter, they have them doing EPS of 34 cents. I honestly think they're going to beat that number by quite a large margin. And reason being, they did 31 cents, and that was with a super messy quarter with all these employee layoffs, these one-time costs, and a bunch of other mess going on for the company. So if anything, I think they're going to actually, let's call it beat this coming earnings in a very substantial way on a GAAP basis. And I could see them easily doing 40 to 50 cents for next quarter as well, okay? Now, think about it from this context, okay? Sometimes I like to just break down things simply, right? It's one thing to get into EPS estimates and, beating earnings and all those sorts of things and what the EPS targets are going to be. But let me just ask you these two questions, okay? Are more people going to be buying more things from Amazon or less things from Amazon in terms of the e-commerce side of their business in the year 2028, for instance, right? I think if I just had to put every single person on the globe on a lie detector test, I think almost everybody would say, yes, people are going to be ordering more things more often from Amazon, right? And that's absolutely my belief. And is AWS far bigger in 2028 than it is today? Abso-dang-lutely, okay? The more you study about Amazon Web Services, the more you just realize, this is still rather early days, and this business has a long, long runway of growth ahead of it over the next 5-10 years, okay? So there are two main core businesses that matter more than anything, have exponential growth ahead of them for 5, 10, 15, 20 years into the future. Someday those businesses will stop growing. I don't know when that is. It's so far from now, it's hard to even fathom that, right? Now, if we go a little deeper in with their numbers, right? Analysts have them doing about $1.53 of EPS this year. That number's far too low, folks. We just saw Amazon easily beat, even in a messy quarter, coming in at 31 cents. And I think they're going to absolutely crush the next quarter earnings, and then they'll crush 3Q and 4Q. This is going to be a year of beats and beats and beats for Amazon, in my opinion. So the fact is, you can look at this and you say, I think they're going to do $1.53. I think it's far too low. I wouldn't be surprised if they do $2 of EPS this year, okay? As far as next year goes, let's say they do $2 of EPS, which I think is very much a possibility for this year, then you have to bring up next year earnings, okay? So right now they have $2.59. If Amazon comes in and beats again next quarter, analysts are going to have to start bumping up their 2024 numbers to probably $3, I would say $3 to $3.15, right? Which means, at $2.59, you're paying roughly a 39 forward P for this company right now based upon 2024 numbers, right? But remember, if they do $3 plus, which they probably are going to do in my opinion, then you're likely paying, let's call it a low 30s PE based upon 2024 numbers, which in my opinion is far too low for a company like Amazon that has 10, 20 years of massive growth ahead of itself. So that to me just, is a very, very attractive valuation. Now, you got to think about competitive threats whenever you think about a company, right? And there's only two main competitive threats for Amazon, okay, for their two core businesses. One is Microsoft in relation to the cloud, and the other is Shopify in relation to e-commerce. Those are the only two main competitive threats they have, okay? Is Google a competitive threat on the cloud? I don't really think so. Is eBay a competitive threat to Amazon on the e-commerce side? I don't really think so. Is Etsy? I don't really think so. So the bottom line is these are the only two companies that are even somewhat competitive threats. But at the end of the day, Shopify is so small compared to obviously Amazon on the e-commerce side. Shopify can build out a great business for itself without really impacting Amazon pretty much whatsoever, and they've been able to do that. Shopify hasn't really affected Amazon in any substantial way, and Shopify's been able to build a very nice business, actually an attractive stock as well, and I do own Shopify. Microsoft, in terms of Microsoft, obviously big dog, but let's be honest, Microsoft has a lot going on at that company, right? A lot of different business lines. And so I just don't think they quite, and it's clear in the market share as well, they just don't quite have the focus that Amazon has in relation to the cloud and arguably the product as well. So when I look at it from that context, they only have two main competitive threats, and I don't think they're as big a threats as some might think, okay? Now, Andy Jassy, the gentleman that leads this company, I really like this guy. I'll be honest, I've watched several interviews with him now from the past few years. I've obviously listened to several conference calls with him. I like this guy. I can understand why Jeff Bezos made Andy Jassy the CEO, okay? He was the one that really grew Amazon Web Services into the giant profit machine business it is for Amazon today. But the thing I love about Andy Jassy is Jeff Bezos really instilled long-term focus with this gentleman. And I mean, like, when you hear him talk, he's talking about building relationships with customers that way outlast, his time at the company or the current employee's time at the company. And I think that's brilliant. That is something I absolutely love. And so I really like this Andy Jassy fellow. I think he's absolutely he's the type of CEO that I feel comfortable having my money in for the next 3, 5, 7, 10 years, because I know he's going to do me well. Let's just call it that, okay? So definitely like him and like the management team. Now, in terms of price targets I have for buying this stock overall, okay? So anything under $100 is like load the boat for me, okay? Where it's just like, buying very, very aggressively. Between $100 and $125, it's a buy for me. $125 to $150, it's a light buy, which means, I just very lightly buy it, kind of in that range. And then once it goes over $150 at that time, it will be a hold for me. And so I believe I'm probably going to have all of 2023 and potentially part of 2024 to be a buyer of Amazon stock, because I think it's probably a good amount of time before it goes over $150. I don't see that happening this year. It could definitely happen in 2024. If it does happen this year, it will likely be in like the fourth quarter of this year, in my opinion, after they've come through and kept beating earnings, okay? So I have a bit of time to buy this one, and that's great. Now you might say, well, why don't you just wait to buy this one, since you might have a bit of time to buy this till, let's say, the end of the year or in early 2024 or something, okay? With these sorts of companies, you've got to work with a sense of urgency, okay? And there's a big difference between FOMO and a sense of urgency in the market. When it comes to companies like Amazon, you very rarely ever get those companies to trade at undervalued valuations and, let's call it attractive pricing to get in those sorts of stocks. It very rarely happens. And when it does happen, you better take advantage of those opportunities. Too many people watched Meta stock last year go under $90 a share and decided not to buy that one because, maybe it'll go to 80, and do I really need a rush to buy it? Well, today Meta's $240, and I'm sure in a couple of years from now it'll be $340 and $440, right? And you had people that were like, well, you got to work with a sense of urgency on these sorts of companies, because I can tell you these are the superstar companies of the stock market, okay? These are the Messis of the stock market. These are the LeBron Jameses of the stock market, okay? These are the Tom Bradys of the stock market. And you better take advantage of those opportunities when they're out there as free agents and they're trading for this so dang cheap, okay? Because if you don't grab it, I can promise you somebody else is going to grab it. And the more investors that obviously buy in, and the less selling pressure, next thing you know, the stock starts to perform really, really well. So I'm working with a sense of urgency around Amazon. I continue to buy the stock on almost an every week basis, and I will not be done buying for quite some time, okay?